This would help eliminate some confusion, I think, for people that think the S&P is just going up forever. If you actually denominate it in gold, the chart doesn't look that great, right? It had a boom in 2001, but it's not been good ever since.
If you simply divide it by the monetary supply, like if the monetary supply is going up by 7% and the S&P is going up by 8%, then the overall market's flat. And that makes sense, because why do people think that stocks should always go up 8%? I'm in business, Robert. It's hideously competitive. Like, do you think that we don't have a competitive market for everything in this country? It's obscenely competitive. And so what you've got, if you look at the NASDAQ, is you have like 5 companies: Apple, Amazon, Facebook, Google, right? Microsoft, right?
Yeah.
Those 5, and aren't they responsible for like 80% of the gain? Everybody else is competing, and it's a competitive market. And what does that mean? It means it's hard to grow 20% a year, because whenever you do anything, someone else is copying you and they're pushing on you. So unless you get a dominant digital network with a near monopoly, with these massive exploding economies of scale on a zero variable cost, low variable cost, it's very, very difficult to perform. I mean, most of the S&P isn't, right? To the extent that the S&P isn't Apple, Amazon, Facebook, Google, Microsoft, they're just a bunch of companies competing with each other. So you would think that they would grow at the productivity growth rate of the overall economy. But of course, which is what, 2%, 3%? Why shouldn't it? If you had hard money, and by the way, coming back to that theory of Bitcoin network value goes through the roof, skyrockets in the early days when there's massive adoption and massive technology explosion. But in the later stages of the S curve, when it's fully diffused and when it's mature, it just grows with the GDP. It grows with productivity of the people in the network. If they grow 2% a year, it grows 2% a year. Mm-hmm. So in a mature equity market, you would expect equity indexes, equity prices to grow with the GDP. If they're growing faster, it's the monetary expansion, right? Expand the monetary supply 7%, expand the GDP 1%, S&P should go up 8%. It's going to be disproportionate. The big tech, the leading edge, innovative tech, is going to be going double, triple, quadruple that. And then the trailing edge laggards are going to be tanking. And then everyone that's working their asses off as hard as they can is going to be barely keeping up.
Right.
Because you have to do 100,000 things right just to stay in business in a real Darwinian capitalist economy. Mm. It's like being flat means defeating 99% of the rest of the market, being flat. To be up, you have to, Amazon's up because they beat 15,000 companies. Right. The next 2 are just slightly okay, and there's some that are flat, and everybody else gets destroyed because of the natural effect there.
This reminds me of the Red Queen from, I think, Alice in Wonderland, which said, "In my kingdom, everyone has to run as fast as they can just to stand still." Right?